Hey everyone, Luca here with a special collaboration for you with Cantonese Cat. How are you, man?
Hey, I'm good. Thanks for doing this. Always enjoy doing these things with you.
Yeah, man, I loved our last talk together on the broader macroeconomic environment and Bitcoin. Today, we're going to have a special topic about Bitcoin miners. So, first things I would like us to emphasize about the importance of having a complete fundamental analysis. Over the last couple of years, we've seen how small caps were impacted by quantitative tightening. And this is very important, especially that small caps have the tendency to be impacted most by monetary policies and the broader macroeconomic environment. Now, the thing is, we've seen small caps basically bleeding and being in a bear market for the past 4 years as the Fed has started to transition away from their quantitative easing measures back in 2021. And then later on, when they have implemented their full quantitative tightening policies back in 2022, when they also start to raise rates and the total assets start to go down. Now, this is very interesting because, as we all know, small caps always need cheap capital and low interest rates in order to fund their operations. When they do not have access to that cheap capital, most of the times they have to attract financing some way. And they do that by diluting their shares. And this is also why the stock's price tends to suffer in these periods. Now, this is why tracking the macroeconomic data and the monetary policies of the Fed is so important, especially when we invest in the small cap sector. So, what are your thoughts on this?
I actually have some thoughts about it later on that I want to show you. I think that this is a very important chart to kind of illustrate in terms of what has been going on really over the last few years. It hasn't always been like that. I always thought that the small caps, not everybody basically have this conception that small cap is underperforming large caps, and that whenever you have any badness happen or any shakiness happen, small caps always going to get getting dumped, and it's safer to be in the large caps. And I think that mentality has always been the case. It does have some tie-in in terms of macroeconomics, but I also think that these things are more cyclical than anything. And I think the cycle between large caps and small caps are actually more spreading towards like decades. And I think the trend may be starting to decelerate here a little bit. I'm gonna try to show you that a little bit later. But it's been the case and it's gonna be the case until it's not. But I think that things might be shifting.
Yeah, exactly. Especially that we've seen inflation basically cooling off over the last couple of months. So we've seen three consecutive readings below 2.5%, which is giving us a clear indication on where monetary policies are headed next. And that I think is the end of quantitative tightening. So I was thinking if the main catalyst that led to small caps underperforming over the last couple of years will go away, and if the total assets bottoms out, then what could happen to the performance of small caps against the big caps and the big equities in the S&P 500? I think that we're going to see the opposite of what we've seen over the last couple of years, which is this midterm reversal as we enter the cycle top formation in equity markets as well. What are your thoughts on this?
If you track the higher time frame, I basically I like to look at these things usually on like the weekly and monthly. And on the monthly, I've been seeing some bullish divergence that's been building up, that tells me exactly kind of what you're alluding to, that there could be a reversal in terms of the small cap underperformance. I also think it's very, very interesting that the quantitative tightening is really looking like it's decelerating significantly, which is setting up for a perfect macroeconomics environment for small caps to actually do pretty well moving forward.
So another interesting thing is how interest rates have impacted the S&P 500 so far. Now, I believe this tells a very important story about how the risk appetite impacts the S&P 500 and the broader markets. Basically, what we've seen over the last couple of years is the S&P 500 being in this major bull market because the monetary policies were stable, interest rates were kept at the same levels, and that has led to a higher degree of confidence and a higher risk appetite from investors. Now, this leads to more investments and it leads to also to higher prices. Now, of course, back in 2023 and all throughout 2024, we've had a very good macroeconomic environment. So we've had a pretty low inflation rate, a high economic growth, and a resilient and strong labor market, which of course led to more certainty and confidence in the economy and in the broader macroeconomic environment, which led, of course, to higher prices. And the way I see this now, moving on from here, and I would like to hear your thoughts on this as well, is I believe we're going to see a very similar period to the one we've seen all throughout 2023 and all throughout 2024, where the Fed will keep holding their interest rates at the same levels as the CME Fed Watch tool currently shows us. The upcoming rate cut is being priced in September. So that gives us a nice 3 months before we'll see any intervention from the Fed. And while they'll have stable monetary policies, we will see a very similar risk-on period to the one we've seen back in 2024, which led to higher prices in equity markets. But this time, however, because from a cycle perspective, we're nearing the end of this bull market, I believe the main spotlight will be on risk assets. And I believe we'll enter a complacency phase in traditional equities and big indices such as the S&P 500 and NASDAQ and the DJI, while liquidity starts flowing into risk assets. So what are your thoughts on that?
Yeah, I mean, over the last couple of years in 2023, 2024, the large cap companies who have really good cash flows, who really don't have any debt. I mean, you're talking about companies that are just holding like billions and billions of cash. They do extremely well in the high rate environment, and their earnings have shown that, and their stock prices also reflected all that. Whereas a little bit more of like those cyclical type stocks like Tesla and other, small cap type stocks, they are more sensitive to, economic environment and rates, and they have really kind of underperformed, right? So at some point, the large market caps that these large caps have developed, the money is going to end up rotating out to smaller caps. I think they're just trying to find an excuse to do that. While I actually think that the whales already kind of seeing the greater picture, they have been accumulating small caps for years, and I think they're just waiting for it to pump, and they're just waiting for an excuse. So to me, I all the macroeconomic environments are there for the rotation to happen. It just simply hasn't happened yet. And on top of that, I think we're still waiting for that final push of liquidity to come in. And everybody's been so bearish on the market for the last 2 or 3 years, especially when it comes to China, that once we continue to have that liquidity kind of flow in, once inflation is not an issue anymore, it really hasn't been. And also once the quantitative tightening is ending, once China continues to print their way out of deflation, it is setting up for perfect rotation into small caps, my man. I mean, I agree with you completely.
Yeah, I mean, we discussed this in our last market talk as well, the global liquidity and how China plans on to stimulate their economy and to print their way out of depression. And I believe it's all setting up to be this perfect build up into this risk on environment that precedes the cycle top. So think about it. The most bullish narratives emerging right when there are the most risks.
The S&P 500 has just gone up so much over 2023 and 2024, and a lot of people are still remaining bearish, which I mean, certainly the April dump didn't help, but I think that is just overwhelmingly majority of folks are still very cautious and very bearish, and we simply haven't had that risk appetite coming back yet.
But do you think that is a bad thing or a good thing that the risk appetite still hasn't come back yet?
I love it. I mean, if you're talking about the macroeconomic environment actually improving, you're talking about liquidity conditions actually getting better, but people are still focusing on whether or not the Fed would cut rates, whether when we just kind of show that it may not matter as long as it's stable, right? Market wants predictability, they want stability. And as long as there's not anything that's kind of throwing us off, I think it's okay. But people getting distracted with all kinds of things like tariffs, trade conflicts. And now they're talking about like the Middle East conflicts, like everything is just, it's like the same narratives over and over again. People getting, scared over and over again. But I think we've seen this movie before, and those people who really know what's going on, I think they are doing what they're needing to do to get them set up for the next run up. Whereas people who are getting scared or continue to be on the sidelines when there's no money on the sidelines still. And the narratives are still bearish. That's a good thing. Yeah, so a couple of things I was kind of wanting to go back to mention that first of all, on the left side over here is the 10-year yield. And on the right side here is the Russell 2000 represented by the ticker symbol IWM. What you're really seeing here is you showed me earlier about the Fed funds rate, but the reality is the market follows more the actual condition, which is based on the 10 year. The 10 year is what a lot of people really kind of pay attention to. The interesting thing is, even though the Fed has held rates up to like 5 point something percent for a very, very long time, and when they said that they're gonna, stay higher for longer, they really meant it. Yields have dropped. Like the peak of the yields was back in October 2023, and that was really the bottom of the IWM. It coincided perfectly with the bottom of the IWM. The Feds didn't really actually start cutting rates really until September of 2024. And that was when they really start cutting rates, right? And people are like, oh, they're finally cutting rates, so IWM must be going to the moon. And then they end up tricking everybody by giving you that November candle to double test the previous all-time high and then end up just rug pulling you after that. Even though the Fed funds rate had been staying the same, 10-year yield has been dropping from like 5% all the way down to, 3.6%. And as soon as the Fed says that we're going to cut rates, guess what happens? The 10-year yield shot up just to throw you off, right? And whenever they said that they're going to stop cutting rates back in around like January of 2025, 10-year yield dropped, I think that liquidity conditions runs based on the market, and I think the Fed and Jerome Powell they lag behind. Even themselves say that they are data dependent, right? So if you look at the yield condition, even if you look at the RSI here back in the days, you knew that there was the RSI for the 10 years getting exhausted, right? As you continue to make a higher high here to 5%, RSI is dropping down here on the monthly. Like this is very, very topping kind of signal. So this is also coinciding with the bottom IWM. What I'm trying to say is like I don't really want to follow what the Fed does because they're lagging. I want to follow what the real market condition does. And that's what the 10 years telling me. IWM bottom in October 2023, 10-year yield top at 2023 as well at the same time. So I follow the market conditions. I don't follow what the Fed, the talking heads are talking about. I just don't do that. The other thing too is when you're referring to the Russell 2000 and the S&P 500, the large versus small cap argument, you're extremely correct. Over the last 5 years, small cap has just been wrecked compared to large caps. This is the Russell 2000 over S&P chart, so RUT over SPX. And with this symbol, I can actually go back to a lot further. I can actually go back all the way to like the 1988. And what you're seeing here is this, right? Like during the dot-com bubble, large caps were just going like crazy, right? So small caps underperformed that, and then the bubble crashed, and everybody rotated from large caps over to small caps like financials and housing stocks. And the small caps ended up outperforming the large caps by a lot over the next decade until you really start to have the great financial crisis when you have, small caps starting to, crash together with the large caps. And then that's when you end up having the rotation back in the large caps over the last decade and a half, 2 decades. And that right now it's just been over exaggerated. And back here, the small caps, they're still outperforming large caps all the way up to like maybe 2011, right? On bearish divergence. Now, what are we having? We're having large caps outperforming small caps for the last 5 years on bullish divergence. And this is on a monthly chart. So that tells me that I think it's going to the extremes here on bullish divergence. I think it's just a matter of time where things would end up just rotating because the common sense right now is large caps outperform small caps. And that's exactly the kind of complacency that I worry about the market participants just keep on having the same thoughts over and over again. So yeah, I agree with you too. From this particular like decade-long cycle, I think a change might happen, and I think the change might actually happen for a lot longer than just short term. Thoughts on that?
I mean, I have an interesting thesis about that, but I believe we're gonna see something very similar to what happened in the Roaring Twenties.
Mm,
So that's a big topic.
mm,
With all the technological advancements, with what happened back in the 1920s. basically what we've seen with the industrial revolution. Now we have the AI revolution,
Yeah.
and we also have very similar macroeconomic environment. So I believe that we're going to see in the next couple of years a hyperinflation environment where small caps are likely to outperform, and this chart beautifully highlights that.
I want to show you something else that I was posting on X earlier too. This is the ARK Fund by Kathy Woods over QQQ. You know how ARK Fund has been bleeding. You know, they're full of all kinds of speculative, high debt stocks, and they have been just absolutely destroyed over the last few years after that bubble from 2020, 2021. If you actually chart that against the QQQ and you do a spread of ARK over RK over QQQ, something interesting is happening too, and I do think that there might be a rotation coming to support your Roaring Twenties idea in terms of innovation, things like that. And first of all, like our fund, they have like the top holdings like Tesla, Coinbase, Shopify, those kinds of high beta stocks that are more liquidity sensitive. If you just chart this spread here, you can see how ARK Fund has underperformed the QQQ for about 3 or 4 years straight. It was just absolutely brutal, right? But with the monthly Bollinger Band being turned on and with the 20-month moving average here being shown, you can see that the 20-month moving average initially was support and it became very, very negative sloping during this big bear market of ARK Fund. And then it became resistance here. But guess what? It has flipped the 20-month moving average from resistance here back into support. And we are also really showing a very, very nice trend change here. And right now, we just bounce off of this 20-month moving average. We could be favoring those ARK fund type stocks over large caps here too. You're not just talking about, small cap. We're also talking about these high debt speculative stocks here as well.
Yeah, definitely agree. I mean, the risk on environment primes all risk assets and all risk investments, right? And I think that the charts always tell a story before the news and before the narratives emerge. I think that this bottoming formation definitely tells us that risk assets are likely to start outperforming in the next couple of months. Another thing is right when we approach the end of any major bull market, that's generally when risk assets start to outperform. Then we sort of have this distribution. The reason why I think this distribution happens in the first place is that we have a very high risk appetite. I believe that the very high risk appetite is what leads to distribution phases in the first place, because that's how market makers can start to distribute whatever they have accumulated.
It absolutely is the case. I mean, I've always think that whenever you have distribution, which is well, I actually don't think distribution is bearish. I actually think that distribution is bullish because they're trying to pump the market and they could be doing that for quite some time. There are some really high beta stuff that they're trying to pump the market for like a few months and then and then that was it. Everybody gets euphoric and that was it. But there's always some distribution cycles that can also last longer too, which can last for years. That note too, I also want to show you one chart, and this is the QQQ over SPY chart. In general, on a more risk-on environment over the last, really 2 decades, and we had a very much of a secular bull market here for a very long time. Generally, the QQQ or the Nasdaq does better than SP 500 or SPY, and you can see that over time, over the secular bull market for the last decade, decade and a half, it's been the case. Like QQQ just outperformed SPY, except for that really euphoric stage with really significantly increased liquidity from 2020 to 2021 that really had gotten us like way outside the upper Bollinger Band for a very long time. This is a QQQ over SPY spread, by the way. So if it looks bullish, that means that QQQ does better than SPY. And this really significant outperformance here, I think that's exactly kind of what you're referring to. They are trying to distribute these really higher beta stocks to get more risk on here, but it was just way too much, and they got everybody all euphoric. And then that's when things crash after they're done distributing all these to retail, right? And we have a bear market where the Nasdaq dropped like 38% and the S&P 500 I think dropped like 26% and it's significantly underperformed. And guess what? Right now, overall, we've had the QQQ kind of getting picked up here again. And overall, they've been doing about the same in terms of SPY and the QQQ. but they're getting ready for the next move here. I see this as a little bit of like maybe like a little bit of a continuation pattern of a cup and handle kind of thing. It's getting ready for something here, and the Bollinger Band is squeezing. So I think that there might be some further outperformance of the QQQ over SPY coming soon, which is going to be, basically increase in risk appetite. The reason why I think it's going to go to the upside after the Bollinger Band is done squeezing and start expanding is because it's on the upper part of the Bollinger Band and because of this pattern that I'm seeing here. And that's what I'm seeing, Luca.
Yeah, I mean, it's definitely hard to stay objective. One of the hardest things in investing is not developing a strategy or to have a fundamental analysis or a technical analysis, but it is to stick to it, right? Because it's very easy to build it, but it's very hard to stick to it, especially when you're in the heat, when you're in the moment. It's very hard to stay objective to your own plan and to your own strategy. So I think that the easiest way through which we can remain objective to our own analysis is by having objective data and not biased interpretations of headlines or ideas from others, but by having our own analysis and by tracking objective charts and objective data. So yeah, as you emphasized beautifully there, the technological stocks have been outperforming the S&P 500, and I think there might be some correlations to why that happened in the first place. As I said earlier, I think we're on the verge of having the second roaring 20s, where technological advancement will once again take over. And yeah, that's why I think that tech stocks will most likely continue to outperform the equities in the S&P 500. All right, so moving to a post I made at the beginning of this year, I highlighted two main scenarios that could take place for Bitcoin miners. Now, in this post, I talked about CleanSpark in particular, but this applies to all Bitcoin miners. Basically, what we had was my base case at the time, which was bullish, which implied that the correction we've seen from November to early January when this post was made was actually a corrective wave 2 that would eventually precede the next impulses to the upside, as you guys can see here. And I made the correlation with what happened in November of 2023, when we also came very close to invalidation, but that phase preceded a major move to the upside. But I also highlighted the potential of a bearish scenario, which implied that we would see a break below the September lows that would flip the high time frame market structure and would make this series of lower highs and lower lows. And that would eventually lead up to this complacency phase and reversal that would eventually precede the bear market. And these were the two scenarios I highlighted at the time from an Elliott wave perspective. So let's now move on to the charts and see what happened next. So moving to the charts now, we have CleanSpark, and what we see here, this is where that post was made. We've had this brief bounce to the upside and then a continuation to the downside, basically breaking below the September lows, as you guys can see here, and also breaking its bullish high time frame market structure by forming this series of lower highs as well as lower lows, as you guys can see here. So for this reason, I'm now considering the possibility where this next reversal ends up being just a complacency phase, just as I showed in the post from the beginning of this year. And this reversal actually leading up to a complacency phase, something similar to this, failing to form a new high that would eventually precede the bear market. So what are your thoughts on this?
First of all, I want to applaud you for having an alternative scenario, because I honestly think that nobody really knows what the future holds. I think it really matters in terms of what you're seeing and what levels you have for validation and invalidation. So it's actually a great thing to think about different scenario. My thought is that I think CleanSpark has been extremely challenging to chart, to say the least. I think looking back at it, I still think that it runs with the IWM and the whole global liquidity phase. I still believe that CleanSpark was one of the early runners throughout 2023, and I think it just went way too far, way too fast, and there are too many people who are getting complacent to the upside, and now I think a lot of people are actually getting more complacency to the downside. When we actually have Bitcoin, making all-time highs, when we actually have global liquidity rising, when overall IWM seem to be forming a base. So I actually favor, maybe we're going to have more higher highs and higher lows moving forward, but it's going to be very slow. I would prefer that actually, so that it doesn't get the sentiment that euphoric. And if that's the case, we actually would be able to not having that complacency, but actually just having a hated rally. That would be my preferred scenario, based on what we just kind of talk about, based on, risk on environment, things like that. With that said, I think what you're seeing and what you're showing is also very technically valid because it's been forming lower highs and lower lows until proven otherwise. So I think that your scenario is definitely something to take into consideration.
I'm personally really bullish, as we discussed earlier, on risk assets in the next couple of months. But this is something I'll be keeping in the back of my mind. I think that being conservative right now is not such a bad idea, especially when we reach these levels. In that post I showed you earlier, I also mentioned that I won't be looking to sell here because that would be just a dumb decision. You would basically sell at the bottom after the whole dump. So instead, I'm gonna look forward to de-risk a little here, and then I'll reevaluate. I think this is the best approach moving forward because that's how we can also combine the bullish fundamental side, as we discussed earlier, with the currently bearish technical side from this lower high and lower low standpoint. So yeah, this is my approach moving forward. What do you think?
It's always good to be cautious, although in hindsight, it ran all the way up to like, $25 from, $1.74. And when everybody was, very, very super euphoric about it, I think that was probably the time to be super cautious on parabolic phase on the move up. We've actually started to develop some bullish divergence, as we have, over the last really last year or so, we started having, some bullish divergence that's being built up during this downward trend here, especially on the weekly, as you can see. So because of that, it actually gets me more excited about it. Because last time when you see that you had a bullish divergence, exactly, you see a bullish divergence, that was really the start of something great, right? And we've been building a very, very similar bullish divergence there for a long time, and now everybody's cautious. So I'm not saying that you shouldn't be cautious. All I'm saying is that maybe not be that cautious until you hit some of the key levels, like you're showing, and then see how it reacts. Because a lot of times you can have a downtrend like this, and you can retrace back to the mean, and sometimes the retracement back to the mean can turn into something else. So I just want to be, cautious both on the upside and to the downside because you always have upside risk and downside risk, and you can't just be looking at the downside. You also have to reassess as it recovers because sometimes it can turn into something else.
What do you think about the latest institutional ownership rise? Because we've seen the institutional ownership absolutely spiking in these Bitcoin miners over the last couple of months.
It's absolutely ridiculous. I mean, I think that, and I don't want to be like conspiracy theory because there you look at this data, you can spin it in, however you want. There's a theory out there saying, like, some people are saying, oh, they might be institutional buying, but they could be letting out to people to short, and then there are also folks that are saying, oh, because the dilution, you have institutional just buying, but the dilution is keeping the price down, is actually not a good thing. Like, you have a lot of people kind of twisting it one way or another. There's even like somebody who mentioned you have increased in institutional ownership, to a certain point. If most of it is being held by institution, then all the upsides already, been played out, right? Like, you don't have any more institutional buying pressure if you continue to have high institutional ownership. So there's people who argue that, but to me, I feel that right now, a lot of the selling pressure are mostly from retail, and they're shifting hands to institutions because the retail sentiment is just extremely poor when it comes to Clean Spark. I think everybody who bought in the 20s are absolutely regretting it. So to me, I feel that the selling pressure is really significantly declining, as evident by the bullish divergence that you just shown. And I think that we might be starting to run out of sellers soon, and with institutional lending out to shorts and and that kind of narratives. But Interesting in your thoughts too.
Yeah, I mean, I think that at the end of the day, it's a level by level market, and this is how it should be approached, right? Because right now we'll have a very strong level to clear. So it will be this high time frame resistance range, which in the past we see has acted as a major support. So this will be pretty much the line in the sand. And I think this is pretty much the level we have to clear in order to confirm that the bearish thesis is not happening. So at the end of the day, it's a level by level market. And no matter how bullish or bearish we might be, for that matter, I think we should be ready to adapt to new market circumstances. And I think that what really tells us the truth about the markets are the charts. Because right now we're seeing extreme capitulation on these Bitcoin miners. The sentiment is absolutely at its all time low. Everyone has mostly capitulated or even forgotten about these Bitcoin miners. And it's expected since they have underperformed over the past few months. But it also creates an opportunity for those that remain. Buying CleanSpark around $6 was an absolute deal for me. And a lot of Bitcoin miners were very cheap. I think Mara even got into single digits as well back in early April. So those were great opportunities, right? And the way I see it is a lot of people have given up on these Bitcoin miners, have mainly transitioned to other investments, right? There are a lot of stocks that have been replacing Bitcoin miners in terms of the new shiny thing. Something I've been tracking was HIMS, and a lot of people who were invested in these Bitcoin miners have sold their miners in order to transition to HIMS. And that has been really interesting to me. You're basically selling something that has underperformed, which has a high likelihood of outperforming in the future, to buy something that has outperformed already and it's likely to underperform on the midterm at least.
Yeah, no, it's very, very sad for sure. I mean, whenever Clean Spark was up in like the 20s, I basically was like, yeah, I'm not gonna buy there. I think that minimally there should be like a 3 to 6 month correction period. I just didn't expect it to like last for 15, 16 months. Like this has been a very, very brutal. I guess that's what it took to really flip the retail sentiment bearish on it before it can actually like, go up higher. But right now, I think we're actually at a point where it's unfortunate. I wish that retail investors and traders won't do that, but I would not sell miners at the low and try to rotate into hymns, which is has been overextended. Also mentioned like 62 $64 is a pretty strong resistance level, and when it hit there, it's been having a hard time getting through it. But people just rotate into it, so it is what it is.
Yeah, I mean, on the high time frames, this has been mostly distribution phase where all the retail euphoria was in, where everyone was buying into these miners. And now it's pretty much an accumulation phase where institutional investors have increased their ownership and their exposure to these Bitcoin miners, and most likely expecting something that is coming in the next couple of months. Something else I've been tracking is also the hash rate index, which tells us how much money these Bitcoin miners make per exahash. And interestingly enough, we're seeing it pretty much at the lowest levels it has been over the past few years, which tells us that there's only room to grow from these levels. Even though the industry is very competitive, because we could see the Fed finally transitioning away from their quantitative tightening policies, allowing cheap capital to enter the markets and access to low interest rates, that I think could act as a catalyst for these Bitcoin miners and create an alternative source of financing rather than dilutive measures. And like we've seen with CleanSpark, something I really like about CleanSpark right now is that they have given up on their dilutive measures and instead they have started to use their Bitcoin reserve in order to finance their operations. So, what are your thoughts on that?
Yeah, the market cap for a clean spark is like 2.6 billion is nothing. I think it doesn't take a whole lot of liquidity coming in to really pump the stock. People are still heavily shorting it. So as soon as the technical improves, And if we end up going for the bullish scenario rather than the bearish scenario that we had earlier, it can really run up in a rocket just because the market cap is extremely small. So it's basically just been falling. These are lock-based fib levels. And CleanSpark didn't really become a Bitcoin miner, I think, until maybe December 2020. So I'm showing a weekly chart here. It's been following these fib levels pretty well. I basically, for many, many different assets, for many, stocks and crypto, the big boss is usually 0.786 fib level. If it breaks the 0.786, generally, I mean, there are always exceptions. Sometimes the 0.86 is also a very big boss. But if it breaks the 0.786, generally stocks just keeps making an all-time high. What happened with CleanSpark was that it went so far up to 0.786 here in a hurry. And in general, for technical analysis, like you always see these things whenever there's a big resistance level up above. Market makers and and whales, they generally like to pump things into maximum euphoria into huge resistance. So 0.76 was a big resistance, and they did that. And again, I'm saying hindsight is 2020, right? I'm not saying that I knew everything that was happening at the time. On top of that, there was a big indicator here called the Ichimoku cloud, right? Basically, it's a cloud that can serve as either resistance or support. If it's big like this, if it's red, generally it's a pretty big resistance level, right? When it ran up, the next natural level is going to be the confluent zone into the Ichimoku cloud resistance right there and the 0.786. That's going to be the where it's going to go. And when you get there, it's going to be huge resistance, right? That's exactly what CleanSpark did. It just shot all the way up, didn't even, let anybody have a chance to get in. Shot all the way up to 0.786 and into the Ichimoku cloud here, got rejected there. And like you said, went through a distribution phase, was holding some of these support levels here for a while, but all these wicks up here, basically, saying that you're losing a lot of momentum. And we end up just breaking down from there. And once it broke down, had a bearish back test, and it just, went down lower. It tried to get back inside the cloud here again, but got rejected here again, right? Rejection here for almost the entire year and a half. Guess what's happening right now? We're entering the cloud. We are holding the zero point 0.5 lock fibs and we're entering the cloud. That to me says that I think we're going to probably end up gravitating back up here to the 0.618 or the 0.707. 0.707 was kind of like the level that you were talking about earlier. And I think that's a very, very important level to break. I think it's going to challenge the 0.786 here again. And if it breaks that, then you're talking about a floodgates of price of high prices, because that's going to be the top of the Ichimoku cloud. I'm not saying that it's going to break through that in one shot. I'm saying that it needs to form higher highs and higher lows one level at a time to get there. And once it gets there, and if we break that, then some of the higher targets are possible. And I'm not even going to talk about what the higher targets are because I think it's kind of dumb to say one level at a time, right? But it's kind of crazy how right now the top of the Ichimoku cloud, which is going to be resistance level right there, is right at 0.786 lock fib. There's a lot of confluence there, and I think that the cloud here is telling us a story. So that's kind of what I'm thinking about CleanSpark here. The other thing I also see with CleanSpark is it's still underneath resistance, right? Usually, I like to look at the 20-month moving average. Once it breaks underneath of that, I get a little bit iffy about a stock unless it breaks back above back test and go higher. I think it's in the process of doing that. So I need to see it really clear like the 11 and a half, $12 level and then reclaim that level from resistance to support. And then I'll be a lot more confident about like the higher time frame, bullishness, but we don't really have that quite just yet. So
Yeah, it's a level by level market, and really nobody really knows what will follow next, right? We can only speculate on what will follow, but at the end of the day, we don't really know. So I think that taking the markets level by level, not being biased about anything, not being all too bearish or all too bullish, but simply adapting to new market circumstances while also sticking to a long-term objective strategy or plan that you have developed through multiple confluences, I think that's the best approach an investor can take. And now, talking about Bitcoin miners in particular, I believe that on the long term, they are looking extremely undervalued. Their market cap is absurdly low. So, for this reason, I believe that on a long term basis, even though the sentiment might be in capitulation territories, even though a lot of people might have given up on these Bitcoin miners, the most likely and reasonable outcome is for them to outperform moving on from here.
I completely agree with that. I also want to circle back to our talk earlier about the broader market, about how there's potentially a rotation from large cap to small cap and also more speculative stocks. It doesn't get more small cap and speculative than Bitcoin miners. It doesn't get more speculative than that. If you are comparing the ETF for Bitcoin miners, I'm showing you here on the left is the WGMI, which is the Valkyrie Bitcoin Miners ETF. And on the right here is the Russell 2000, which is the IWM, which is the small cap index, essentially. The Bitcoin miner ETF here, it didn't really start until February 2022. So I'm gonna do a fib, a log fib level here from February 2022 for both of these and kind of line them side by side over here. All I'm trying to show you is that this is all a liquidity game. And whenever there's sentiment going in and whenever liquidity is going to small caps, and Bitcoin miners are small caps, I think that they would benefit from that liquidity. And I think that once IWM starts to make all-time highs again, I think the miners will end up flying together with it as well. Because if you just start the sequence of fit level from February, or I guess this is January, January, February 2022 to the bottom over here, you can see how they actually line up very well with the fit levels. They basically are the same. When the IWM was having this, washout up here back in November 2024, the miners also look pretty good. Like there are certain miners like Iron and Wolf that really have outperformed. I think that it's basically a liquidity game, and I think that the accumulation had been done, and I think this is a reaccumulation. And we'll see what happens. That's why I always like to pay attention to what IWM does, because I really do think that the miners follow IWM actually closer to Bitcoin because they're businesses.
And it's very interesting how the fundamental side also correlates beautifully with the technical side, as you're showing here. And as we discussed earlier, I think that there's a very high likelihood that we'll have a rotation towards small caps in the next couple of weeks and months due to the main catalyst that led to the underperformance in the first place coming to an end, which is quantitative tightening. Both the fundamental, the technical, and the sentiment side all correlate with each other and all point towards the same thing, which is this bullish reversal in the next couple of weeks and months.
So I just want to also go through just one quick thing here, which is dilution of the miners. As you mentioned too, I think CleanSpark has already changed their strategy. This is Mara. And I wanted to point out this, I think this post I made a while back, like a few months ago, but the truth remains the same. Whenever they end up having the majority of the dilution, that generally happens during the euphoric phase. And the stock can keep going up, even if you end up doubling the shares and tripling the shares, as long as there's increased liquidity. And remember how much liquidity has been flushing the system from 2020 to 2021. During the bear market, Mara had barely diluted. I don't think that the current downtrend is because of the active dilution that everybody's talking about, because it just doesn't correlate. And honestly, comparing to dilution to the potential global liquidity that could come in and the RWM liquidity that can come in, the dilution is probably nothing because these are actually very, very speculative and small cap stocks. All it takes just a little bit of liquidity to come in and for shorts to close their positions. And these things can move, in a pretty drastic way to the upside. I'm just saying that I'm not sure if everybody just keeps on talking about dilution, dilution, if it's necessarily the reason why miners are underperforming right now. I think is shorts, and I also think that they are moving stocks from weak hand to strong hand and is going through reaccumulation range.
Yeah, I mean, we always need a strong narrative to shake out the weak hands. Every time we have some bad incident happening, we need some sort of narrative that justifies it. And I think that the dilution narrative has been just that, right? I've been tracking the outstanding shares for Bitcoin miners over the past few weeks and months, and they haven't been growing that much. But still, there are a lot of people who use the dilution narrative to justify the underperformance of Bitcoin miners. I think it's related to the sector as a whole. Small caps have underperformed as a whole because the risk appetite of investors has definitely went lower, and we have yet to enter the full-blown risk-on phase in the markets, which I believe is coming in the next couple of weeks. On one side, that's a good thing because it signals that the distribution phase still isn't here and that the most likely outcome is for the traditional assets such as Bitcoin and the S&P 500 and so forth to go higher, because it means that the distribution towards risk assets still isn't here. And I would love to touch on this topic in the next collaboration about altcoins and what the performance of altcoins implies for the broader cycle of Bitcoin. I think that would be a very interesting topic as well, because a very similar thing is played by small caps for the major indices in traditional equities. When we have small caps outperforming, that signals that we're entering a distribution phase. But when they are underperforming, it signals that the risk appetite still isn't sufficiently high to lead to distribution phase.
Yes, I think the patience will be rewarded, as it always has time and time again, even though things may not look that great. And I would love to join you again for the next time.
Looking forward to it. As a conclusion, where do you think the biggest opportunity lies next?
I think the biggest opportunity lies next in stocks that people are not talking about. To be honest, I think miners are out of favor. I think altcoins are out of favor. I'm not saying that they're going to go to the moon immediately. They're like going to just V-shape out of the way. I generally like to look at things when people are not looking at it. I'm even for stocks wise, I'm even looking at like other small cap stocks that people aren't even talking about that much yet. So yeah, I love to stay quiet, and I've learned the hard way somewhat, with the miners. There's certainly a lot of lessons to be learned here. So the great thing is not be absolutist about things and don't over leverage.
Yeah, man. It's been a great market discussion with you.
As always, I'm looking forward to the next time, Luca.
Yep, it's been amazing. Thanks for joining this market talk, and I'm looking forward to the next one.
All right. Have a good one. Take care.
You too, man.
Yeah.